I got a lot of requests to do yet another video on Nike stock. This is a stock I reviewed 2 or 3 months ago. I was very bearish on the company because of the inventory issues, lower margins. I said the company's valuation doesn't make sense at all when it was sitting around the $110. Well, now Nike is sitting around $98 per share. So maybe the valuation makes a little bit more sense at such prices. This is what I'm going to review in today's video. Look at the valuation, the inventory problem, the balance sheet, a lot of things around Nike, and try to determine if Nike is actually an amazing buying opportunity at such prices as it's trading at around pre-COVID levels, or maybe it's somewhat of a value trap and we should either ignore it or maybe wait for a better price. Now, if we look at Nike's latest earnings, it wasn't the best at all. The market freaked out because Nike posted its first quarterly miss in the last 3 years, and they got around 66 cents versus 67 cents. I mean, this should not have been a surprise. We have massive slowdown in the global economy, especially in the discretionary items where Nike actually operates, although Nike has some kind of a cult following in terms of the brand around a lot of their shoes, a lot of their sneakers and stuff. But it's just a slowdown. A lot of companies are experiencing that. Makeup companies, shoes companies. It's ugly, and this is starting to bite them, especially where Nike is operating. And this is the biggest problem that Nike actually had, was the inventory problem. And as you could look at the inventories, they went up to 9.6 billion in August of 2022, much higher than the historical average. And they have been working on bringing them down, and now it's around 8.4 billion, which is still much higher than the historical average. Now, Nike, as management, actually missed a massive problem, and this was actually fake pumped up demand. We had the COVID checks kind of thing, stimulus checks in 2021, and people said, and Nike saw that maybe this will continue in 2022, and this is just the new normal or something. And they were facing pumped up demand in 2021, so they run up inventories huge into 2022, and they have been facing an inventory problem since then, and they will continue facing it going into 2024 until they get the inventories back under control. This is the biggest problem with Nike right now, is mainly the inventories, and the inventories is causing them to increase their SG&A spending in terms of selling and administrative, especially in marketing and stuff. It increased over 11% year over year. They're having to run it up and do promotions, do a lot of sales, a lot of marketing, just to get the inventories back in control. And this is affecting them a lot. And you could see where it's actually affecting them. And this is mainly in the operating margins. Operating margins used to be 16%, and they have been deteriorating. And now they're sitting at 9.5%, which is very bad. All of that just because of the inventories. But their gross margins have also been declining a little bit. They kind of face it on supply chain issues, a lot of other freight costs, higher gas prices, a lot of other things, which I don't really believe this whole thing. But a lot of it, this is what they said. But the biggest expense, in my opinion, was the higher marketing expense. And this is mainly because of the inventories. And this is what has caused operating margins to decline massively. And not only operating margins are much lower than they used to be. You look at the return on capital, it's much lower than it used to be. It used to be in the high 29 to 30%. Now the return on capital has been deteriorating, and it's only 12%. So the return on capital is much lower. Gross margin is much lower. Operating margin is lower, and growth is even lower than before. Yet if you look at the price to earnings ratio, forward earnings for Nike is still sitting much higher than it used to be before. Only it's now sitting at 26.5 times earnings. The historical mean was around 25 times earnings. So the valuation is starting to get there. It's starting to look closer to what it was before. So this is a massive improvement. When I talked about Nike, it was sitting around 29 to 30 times earnings. Now it's sitting at 26.5. This is a massive improvement, but it's still trading at a much higher level than the historical average, especially if you look at where the return on capital is much lower, and the operating margins are much lower. The growth is much slower, yet the valuation is much higher. And this is something that I can't understand. This is why I avoided Nike before. I told people to avoid it. But this is, not a good way to judge a company, just looking at a forward PE ratio, which is why I'm going to get into my valuation model very soon. soon. But before I get into it, I want to take a quick look at the balance sheet. It's actually not bad at all for Nike. They have something like 10.5 billion in terms of cash and cash equivalent. They don't have anything crazy on current liabilities, 9.2 billion. Long-term debt is 8.9 billion, and they have some operating lease liabilities of 2.7. So most of the cash actually covers the short-term investments, and Nike is a free cash flow machine. So I'm not very worried about the long-term kind of debt. I think the balance sheet is fine. The biggest problem, as we talked about, is the inventories. Nike is working on it. They're going to still have to increase advertising spending going into 2024 to try to get rid of the massive inventories that got built up. So the margins are going to be facing some pressure for the next few quarters, I personally believe. But this is, again, not enough to make a conclusion, which is why I'm going to get into my valuation model right now to determine if Nike might be a good buying opportunity at such prices, but maybe it's a value trap. Now, for my gross numbers, the revenue growth, I use 7%. The analysts, they expect between 7% to 9%. Nike has been growing 10% this year. So I believe 7% is a very fair estimate. I'm not trying to get the best case scenario, not the worst case scenario. A fair estimate, in my opinion, it's 7%. And this is all guessing, of course. No one's going to know for certain the exact number over the next 5 years. But I personally believe 7% is fair. Net income margins, they used to be 12%. Now they are around 9.8%. I'm betting in this scenario that they're going to get rid of the inventories in 2024, that their margins are going to improve, and they're going to get back to the historical average of around 12%. So I use 12% net income margin for Nike. For a PE ratio, we talked about the PE ratios, that it's sitting much, much higher than historical average. Now, the historical average is around 25 times earnings, which I personally believe is a very, very fair estimate for something like Nike. It's not going to trade at 15 times. This is a high-quality company. It has a lot of brand loyalties, a lot of intangible assets in terms of the brand, and a lot of other things. It's not going to trade at 15 times earnings. But I personally believe it shouldn't be trading at 35 times earnings either. The company was trading at 50 times earnings. To me, it was absolutely ridiculous. But I believe 25 times earnings is a very, very fair estimate. Using the 3% dividend, which is not a dividend, it's around a 1.5% dividend, and they do buy back stock every single year around 1.5 to 2% of the shares outstanding. So I used 1.5% for that. In total, that would be 3%. In total, I get 58% on the upside, or 9.5% compounded every single year for the next 5 years. This is not a bad return at all for Nike. But if I want to get a double on my money buying Nike, I would have to buy it around $77.83 per share. Now, $77 is a very low number. It's even lower than what it was in October and September. It's actually as where it was trading at in March 2020. Now, I'm not sure if it's going there. A lot of stocks with bad sentiment, Disney and others, they went there. I'm not sure if Nike is going there, but maybe Nike trades back at 30 times earnings, which is, it could be much, much higher. If it trades at 30 times earnings instead of 25, then the share price required to get it double is around $91, which is a much, much actually reasonable number in my opinion. If you do a basic chart on it, I said the most likely scenario is that Nike is going to go down, is going to hit the $91 per share range and maybe bounce from there or just start going up. This is, of course, not financial advice, but I believe I would not be personally touching Nike above $91 per share. This is just my opinion, especially if you look at the market. There's a lot of other undervalued names. Even Crocs is trading at 7 times earnings. I did a video on it if you're interested in checking it out. There's a lot of better opportunities in the market, in my opinion. I would not be dying to own Nike at $98. This is just for me. I would not personally touch it above $91 on the best case scenario. Maybe the fair case scenario or something like $78 to $80 per share. So this was my honest opinion on Nike. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.